Hey guys, hey! It's another Wednesday. What is that? A water cooler Wednesday?
Yeah, not just any Wednesday, water cooler Wednesday.
Water cooler Wednesday. So we're so happy to be here with you guys another day. So my name is Dion Branch with EXP Realty, and I have my
Where are you
co.
pointing? Where are you
Yeah,
pointing?
right. I'm pointing there. Right, but I'm getting ready to switch you in a minute. But
Okay. Right, because I'm under the EXP sign.
right.
Okay. Lisa, House Money Mama. Hey, Miss Valerie.
Right. You sure enough not excited today, it's Lisa. That's money
Yeah,
mama. We
maybe I'm
normally get normally get more excitement from you. All right,
tired.
crowd, we gotta cheer her on. She's kinda long day.
Right.
We've been working, trying to get to you guys, get some buyers, get some sellers. We're out here every day. So
Every day, hitting the ground, beating that pavement.
right.
Mm.
So Lisa, we always get these clients that they're looking for a property, and then the question is always, how much do I need to bring to the closing table? Right.
That is a question we get a lot.
Right. So all the
I mean, I
time.
guess it makes sense because if I was buying a house, I would want to know what am I going to have to spend.
Right.
So,
So you trying to figure out like how much do you need? Do you have enough? You
right,
know, should you not get this house? What does it mean? And so we understand that, but sometimes I think it's kind of hard for us to give you an exact number, or at least to give an exact number. And so um, we always want to be able to give you some idea, but understand that it's just an estimate. Like it's an
right.
estimate, right? And so what we're talking about today is just like how do we estimate how much you need to bring to closing? And you should always ask your lender, no matter who it is, but we know you use a house money mama, but you should always ask your lender those questions like how much, what do you feel as though I need? Because they're gonna start out you out with the pre-approval, and
Hmm.
then they're gonna send you and your pre-approval to me and say, let's okay, go shopping.
Right. Go
But
buy a house.
go buy a house, right? And so then we're out there with shopping, and you're like, okay, so now what? And so today we wanted to just kind of talk about that. Like, now what? Right? What's that now what? What happens after you find a house? Or how do I know I have enough money and I'm prepared to even start this process?
Yeah,
Uh, right. And right. So like Valerie says, do you need to have money in the bank?
that's actually a
Yes.
good question. Yeah, that's a good question. Because no, so depending on the age of our audience right now, back in the day, you could have what they call mattress money. So
Right.
that could be money that's basically was just cash. You didn't have to explain where it came from. Because grandma she had stuff in her
Mm-hmm.
bra first,
Right.
and then after that, from the bra would go underneath the mattress. So we used to be able to accept money like that, but no longer. We can't do that any longer. So now we have to source all of our funds. So that means any kind of money that goes into the transaction, we have to know where it came from. So there are some rules around it, to be more specific, but we're not honing in on that today. That would be if you have a question about how that works, feel free to give me a call. I'll be more than happy to explain and go over some examples with you. But for the most part, what you do need to know though is that funds that are part of the mortgage transaction, we have to be able to show where they came from. So you do need to show it in a bank account. Um, If somebody gifted it to you, we're gonna have to see their bank account.
Right.
And like say for example, if you sold something and got money for what you sold, a car, jewelry, anything, then you would need to be able to show a receipt, that there was some kind of bill of sale. So again, then we, have some kind of idea where the money came from.
But you just as a side note, but if the money is in there 30 days prior or maybe 60 days prior, I don't know what that number is. Do you
60.
still have to know where that money came from?
If it's 60 days into your bank account, then it's considered seasoned. So seasoned money, we don't have to show evidence of how that got into the account. So, so yeah, if it's 60 days into an account, but also keep in mind, we do ask for, at least 2 months bank statements too. Usually when I do a pre-qualification, that's what I'm looking for. That's one of the items that I typically request is seeing 2 months of bank statements. So, obviously usually bank statements, they cycle every 30 days. So that will, cover your 60 days.
Mm. All right. So if you get it in there 60 days prior, then you might not get all the questions. But you didn't hear it from me.
Well, part of our suggestion that we make when you want to do house buying the right way is that you want to prepare.
Right.
So prepare means, not at the last minute I'm scrambling to get money. Prepare means, okay, I'm putting money aside. It's realistic that people will take maybe a portion out of their paycheck every week, or every 2 weeks, whatever often you get paid, and start putting that money aside. Some people, I've known people to open up a whole new bank account and they just call the bank account money for my house, or something
Right.
like that, because they're just putting the money aside, to save to be ready for their home purchase. So yeah, you can definitely just start saving that money, put it in an account, so that way we can be able to show where it came from.
Okay. All right. So now Lisa has given you a pre approval. We're able to go shopping. We go out and we see a house and we decide to put an offer on the house. And that house, we've decided to bid 250,000, Lisa.
Yes.
We've bid 250,000. We've submitted our offer and they have accepted it. Okay.
Hmm.
So now
So
we're
now it
off
just
and
got real.
running. Exactly. Right. We're off and running. Now what? Right. So, all right. So now what, Lisa?
So now, well, actually show. I did a little sheet just to kind of give an outline of what we'll be looking at for a purchase. And let me change this here, and then I can share that with you guys. All right. So is it should come up in a second.
There you go.
All right. Yay. So this is an example of we're doing an FHA purchase because that's what a lot of my people qualify for is doing FHA. For some it makes the most sense. For some it's the only way they can go. So either way, this is our purchase now. $250,000. That's your sales price. That's what you're buying the house for. That's not what we finance though. Actually, we finance your skin in the game deducted from that. So like right here, you see where it says 8750. That actually is your 3.5% down payment. Because for FHA, there's a requirement, a minimum required investment that you have to put into the transaction, and it's always 3.5%. So in this case, that ends up being $8,750. So we're going to come back to that because I want to kind of separate that out. I know, Dion, you have another way. I guess if you want to go over
Don't
both.
worry about it. Don't worry. Just
Okay.
right.
Because there's more than one way to look at it. So, when it comes to numbers, you can manipulate them a couple of different ways. So, but basically, my thought, usually what I tell people is a good number to remember is 4%. So when I think of how much you typically are going to need to spend, into a mortgage transaction, it's probably going to end up being around 4%, maybe 4.5% of your purchase price. So in this case, 4% of $250,000. That's what, 10,000, like 10,500, something like that. So, excuse me, it's probably even 10,000 because 25 times 4, basically. But
I
anyway,
thought it was 11.5 or something. But
for 250,000,
mm-hmm.
let's figure it out. No, it's 10,000 even.
Oh,
Um,
that's 3.5%.
that's 4%.
Oh,
That's
okay.
what I'm saying is the total amount that you will likely need to spend for your transaction. Now I'm going to break down how that ends up coming up to approximately that amount. Okay. All right.
Mhm.
So what we have, obviously, your 8750. That's your down payment amount. That you have to be able to come with that amount as part of the transaction. Now, you want to keep in mind a couple of things, and we'll talk about this on our part two of this, and we'll talk about it in more detail. But even with your 3.5% down, there can be times when the credits that you end up getting on your mortgage transaction, either from the seller, from your taxes, different things like that, or lender, I've been known to give credits at closing. Those things will offset what you end up having to bring down here as your total in cash to close. Okay. So up here we've got your earnest money. Now I want to let Dion talk about that because usually at the point where you're putting down earnest money, you and I have probably already had a conversation about it, and I've explained some things about what you should do. For example, for earnest money, you want it to be like a cashier's check. Don't go to the currency exchange to get a money order because then I can't prove. Again, remember I got to source your money. I can't prove that that money came from you. If you take cash into a currency exchange and you get a money order or a cashier check or whatever from them, I cannot prove that that money came from you. So the better thing to do is get the money out of your financial institution in the form of a cashier's check or even a personal check is okay. But normally they want certified funds.
Right. Most of the time, they ask for a cashier's check or
Mhm.
certified funds, as Lisa's saying, for your earnest money. And so, your earnest money is really just, again, it's your money that shows that you're a serious buyer and that you are willing to put this money down to secure your contract. So it's like your money that you're saying, I'm good with this deal. I'm gonna put some money down on this deal because I know I'm going to make it to closing. And there's a couple of times your earnest money is able to come back to you in a couple of different ways. It is after it's during that attorney review period where you're doing a home inspection and maybe you find some things that you don't like about the property or
Yeah.
just decide that you don't want to move forward. So this is a attorney review period in time you could do that. And then the only other time is once you're out of that period. Once the only other way is at when if the lender says that you're denied your loan, but the only reason you'll be denied while working with Lisa and I is because you did something wrong. You went out and bought that car we told you not to.
Right. We said
Right.
wait on the yacht after the house.
Right. So we have our 10 commandments that we share with you as far as 10 don'ts. So
Or
don't do
something
any
like
of
that.
those.
Yeah.
Right. Don't do any of those. And we'll share those another time. But then you'll be okay. So but those are the only times that you'll get your earnest money back. And
Well, appraisal though, because with the appraisal wouldn't if the
correct.
like say for example if the appraisal comes in under the value that you agreed the sales price that you agreed to, then at that point usually what I tell people is you have three options. So like let's just say for example in this case, obviously if you buy the house for 250,000, it needs to appraise for at least 250,000. So let's just say it comes in at 240,000 instead. So now when that happens, you have three options of what you can do. You and the seller can make an agreement to meet somewhere in the middle. Maybe they say, well, okay, I see they said it's not 250,000, but I think it's at least worth 245,000. And so you say, okay, I agree we can do 245,000. And then you pay that extra $5,000 at closing because we're not going to put a lien on it for more than what it's actually worth. So that's one thing that can happen. Second thing that can happen is great. Okay, it came in at 240,000. That's not what we was thinking or expecting, but since that's what the appraiser said, we're going to go ahead and sell it to you for 240,000. And now you get to buy the same house, but $10,000 less. So not necessarily a bad deal for you, right? The other
Mhm.
thing could be you say, okay, we agreed to buy it for 250. It came in for 240, and the seller's like, well, I'm not selling it for nothing less than 250. You said, well, I ain't paying more than 240. Y'all at odds. You can't come to an agreement. So then you both walk away. And if you do walk away, at that point, you should be able to get your earnest money back.
Correct. Right. Right. So, all right. So we've talked about earnest money, and then the next thing is after you've done the place your earnest money down, because
Mhm.
typically you have to do that first before they allow you to have a home inspection. And so the home inspection is again now that is for you. That's a benefit for you. So you have an expert walking you through the house and explaining to you things that they are seeing with the property. They may not see anything and they may just be explaining to you this is your furnace, this is how it works, this is, just your electrical. So inspector does a lot of different things, but their whole purpose is to review the house and make sure that there's no issues with the property and help kind of help secure you and let you know that you're buying a good property. And so from that point, the inspection is normally about 350, maybe to $500.
They get
Um,
that high.
yeah, it
Dang.
depends. It depends.
Okay.
And so maybe 350, 400, 450. So but during that time, they're providing you a report that you can give back to your attorney. And during that attorney review period, you can make requests to the seller to say, I have a concern with the electrical or the plumbing or the roof and things like that. Not
Mhm.
cosmetic items.
Right. Right.
Mhm.
Yep, absolutely. Okay, so now you've got your earnest money turned in. You completed a home inspection, cleared it. You got a good report card, came off at least a B plus. Yay.
Mhm.
So now we go to the next part that's going to be a requirement for the lender, and that will be your appraisal. So the appraisal usually now, everything has gone up because of COVID. We all blame it on COVID, but anyway, appraisals now cost about $650. I've seen them as high as seven, depending on the area and the supply and demand for getting an appraisal done. But an appraisal, basically, we've talked about this on some of our episodes before, is basically to determine value. So one of the things that, and I'm pretty sure we explained this in much greater detail on the previous podcast that we talked about this on, but there is a difference between an inspection and an appraisal. I just had this conversation a little bit earlier today with one of my customers who's going to be closing on her home on this coming Friday. She was asking about doing a home inspection. I said, well, we can't make you do it, but if it's something that you're interested in, it's not a bad idea because I like whoever was our guest that explain the home inspection as being like a report card. That's a
Mhm.
great way to think of it. And I shared my own a little testimony, I guess you could say. So I'm not handy at all, like at all. I can screw stuff in, but I can't fix nothing. So when I moved here to buy my home, it needed to be in good enough condition where I wasn't gonna have to fix anything because I wasn't gonna know how to do it. And I knew my resources for who I could call at the drop of a hat to come and do it for me. So
Right.
long story short, um, the inspector had mentioned about the furnace for my house. He was like, it's really past this stage of life. Need to keep an eye on it, blah, blah, blah. Because if I were you, I would replace it. And I'm like, oh, okay. Now, I ain't gonna lie, I ain't replace it. It's 2.5 years. It's still going strong. We ain't had no issues. Well, we did have one issue, but I was able to fix it. It was that small that I was able to fix it. That's saying a lot. But at any rate, with the furnace, I've been much more mindful. Now, I'm not gonna lie. I think if I wouldn't have had the inspection and if he hadn't given me that heads up, things to look for, the fact, that the age of my furnace is so old and things like that, I wouldn't be as in tune to what's going
Mhm.
on in my house. So I think for me, even just having that, that additional information and knowing, okay, I need to be mindful, watchful. I know my roof is only good for the next 10 years. When you're a homeowner, again, we talked about preparation. You want to start to prepare for things. So if you already know your roof only got 2 years of life left on it, don't wait and see what happened. Make a plan. Okay, well, let me put aside some money because I know,
Right.
2 years from now, I'm gonna need to replace my roof. That's the life expectancy for it. So I'm just gonna be prepared so that when it does happen, it doesn't catch me, as they say, with my pants down.
Right.
So
Sometimes I think of a home as an inspection as a honey-do list, right? So
mm.
it might not be for your honey, but for you, but it's a to-do list.
Right. There you go. So then after you get your appraisal done and we've determined the value that the home is worth $250,000, woohoo. And so now we're going to move forward because now we don't have any issues. Now we've had the attorney review, we've negotiated everything we need to negotiate. Everybody is happy with the transaction. We just ready to close. So now at closing, that's when you get another time. There are basically 4 points where you have funds that go into this transaction. We've just covered three: the earnings, then the home inspection, and then the appraisal, and now your cash to close. That's going to be your last time putting money in. So cash to close is going to be what you actually bring to the table. So because it's a little bit complicated, we're not going to go into the details of it today because we want to have enough time to really cover it as thoroughly as possible on the layman's level. So we'll do that part next week. But just for today, just keep this number in mind. So I highlighted it. Hopefully people can see it okay. Maybe
No,
I should
well,
make it
it's
bigger. What do you think?
well, we see it's lit. It's lit. Yes.
Okay. All right,
Yeah.
cool. So what you want to do is I normally think of your average amount of cash to close is going to be 3% of your sales price. So in this case, that's like $7,500. So you would expect that the title company is going to tell you, or really I'll be the one to tell you, but that you will get the information that the amount that you need to write that last check for when you come to closing and get those keys is going to be about $7,500 on a $250,000 transaction. So looks like we got a question.
Yeah, we have a question.
Okay. Do you want to read it off?
Oh, okay. I'm reading. The question
You can read
was,
it today.
how does the bank determine how much you can get approved for?
So the lender, we determine how much you get approved for basically by way of what I call the CIA. So I do an analysis of the credit, the income, and the assets that you have. So, obviously you've heard that you have to have a certain credit score and things like that. So for me, I can go down to 580 on the FHA. I prefer you to be at a 640, 660. That's always better for you. And then we look at your income, the consistency of your income. Have you been working for the past 2 years? Have you had any long gaps of unemployment? Have you switched jobs a lot? Different things like that. We look at all of that. Then we also look at your assets. So that would be what we're talking about right now, the money that you're going to need that goes into the transaction. So that could be money for the appraisal, home inspection, the earnest money, the cash to close. And on some, depending on your file, sometimes depending on how many units you're buying as well, there could also be a cost for what we call reserves. So if you purchase a building, let's say, for example, because we highly encourage people that if you're on your first purchase, instead of going for the single family, if you can wait it out a couple of years, go ahead and do a multifamily. So then you can start to collect some rent in addition, to becoming a homeowner for the first time. So what you would do is, excuse me, oh, I lost my train of thought. Hold on. So for your multifamily, blah, 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 blah. I started reading something. I'm sorry, y'all. We would look at your assets. So how much you actually would be paying, what you would need to have. So those reserves would be like, for example, if your monthly mortgage payment was $1,500 and you had to have 2 months of reserves, that means you need to have $3,000, 1,500 times two, sitting in an account. And in that account, it has to be liquid. So like a checking savings, something like that, something you could easily access. The purpose for it is not that you have to spend it. It doesn't become part of the transactional money. It just becomes part of what you have available, because what they want to know is that if something were to go awry, you would have something you can fall back on to still be able to pay the mortgage. Because at the end of the day, what does the lender want to know?
Can you pay your mortgage?
Are you going to pay that money that you owe me? That's right. That's what they want to know. Are you going to pay that money? So that's what the reserves would be for.
All
Hopefully
right.
that answered that question. We could talk again. We can talk in more detail. Cynthia, if you have some, more specific questions, feel free. Go ahead and give me a call. Shoot me a text 630-977-6150. That's my direct number, and you can feel free to reach out to me. I'll be more than happy to answer any of your questions.
Yeah, yeah. So we know that this is going to be a two-part. So next week we're going to talk a little bit more about it. But Lisa, do you want to? So right now you're saying 7,500.
Yes, I'm saying you probably have to come to closing with about $7,500. So your total, you're welcome. So your total amount ends up being all of these amounts: the earnest money amount, the 1,500, the home inspection amount, the 350 to 450, the appraisal amount, the 650, and then the money you actually bring to closing, which is the cash close, 7,500.
Right. So
So
now
I'm sure if we added that all up,
highlight the first three that we talked about: the earnest, home, and the appraisal kingdom. Now,
mhm,
one thing I just want to point out is those things are due pretty much within the first week of the transaction. Once you get
yeah.
pre-approved, no. Once you
Once
get
you find a house,
find a house
yeah.
and your contract is accepted, and we have what's called an executed contract, and they've accepted your offer. 2 days after your offer is accepted, you have to put down the 1,500. Then right after that, we need to do a home inspection within 5 days of the offer being accepted. So within those first 5 days, it's a home inspection. Sometimes the appraisal may be pushed back a little further because we might have saw something in the inspection, and we want to tell the seller, hey, you need a handrail down the stairs. You need smoke detectors.
Mhm.
in in the in the house. And then those things will might hold the appraisal back because we know that those are things that normally get flagged during the appraisal time.
Yeah.
Um
Yeah. So we always
so
want to be proactive. We tell you to be prepared, so we want to be prepared too. Because
right.
there's no sense in having an appraiser come out and knowing that there are going to be some repairs that he or she will require. So the best thing for us to do as your team is, say, hey, you guys need to work on these issues. You see this a problem, go ahead and fix them. Then we'll send the appraiser out. So that way they don't have to come out twice. Because if they come out a second time, of course, there's a second fee. It's not a $600 fee, but still, why pay a second fee if you don't have to?
Right.
Yeah.
Okay. All right.
So I think that's it for today because those are basically the ones. That's kind of like your overview of your money in, just skin in the game for the transaction. But then we can definitely go back next week. What we want to do is start to talk about how those items break down because I know you're probably wondering how you come up with $7,500, for my cash to
Right.
close. Where is that? I'm just pulling it out the sky. No, I'm really not. It's
Right.
it's an estimate, but it's an estimate based on something in particular. So we'll share that with you next week, and we can talk about that and give you more details.
More details. So what we want is we're trying to make sure you guys are prepared when you come to us. So you've already saved. We talk about preparing. This year is all about preparing. So let's make sure you have all the knowledge that you need in order to go forward. So if you do find that you're ready, you can call Lisa. Got a number right there. You can start with your pre-approval process.
Yeah.
If you're already pre-approved by another lender, you can always still call me. I work with everyone, and and we can go out and start finding you a house. So, all right.
Mhm.
So we definitely thank you for joining us. We're so excited for you guys to come join us every week. Come back next week so we can talk about part two of what money I need. Like what's
Right. Right.
what's this cost all about? That's
Exactly.
right.
Home buying dollars and
Right. Thanks, guys.
cents.